Welcome to the Money Context, where we explain how money systems work. If you find this kind of explanation helpful, consider subscribing. This channel is about clarity, context, and understanding how economic systems actually affect everyday life in the United States. For most of modern American history, debt was something people tried to avoid. Borrowing money wasn't unusual. Mortgages existed, and some families used loans to buy homes or start businesses. But in everyday life, debt often carried a certain level of caution. Many households viewed it as something temporary, a financial tool used carefully and paid off as quickly as possible. Over time, however, something began to change. Today, debt is no longer seen only as a temporary tool. For many households in the United States, it has become a normal and ongoing part of financial life. Credit cards, auto loans, student loans, personal loans, and other forms of borrowing now play a role in how millions of people manage everyday expenses. This shift didn't happen overnight. It developed gradually, shaped by changes in the economy, the financial system, and the cost of living. To understand why debt has become so common, it helps to step back and look at how the financial landscape has evolved over time. One important factor is the rising cost of essential goods and services. Housing, education, healthcare, and transportation are major parts of household budgets in the United States. Over the past several decades, many of these costs have increased significantly. Housing prices in many cities have risen faster than wages. Higher education has become far more expensive than it was in previous generations. Healthcare costs can be unpredictable and sometimes extremely high, even for households with insurance. When the price of essential services rises faster than income, households often face a difficult financial equation. Income remains relatively stable, but expenses grow. In situations like this, borrowing can become a way to bridge the gap. A credit card may help cover an unexpected bill. A student loan may help pay for education. An auto loan may make it possible to purchase a vehicle needed to commute to work. These forms of borrowing can provide access to opportunities and necessities that might otherwise be out of reach. But when borrowing becomes widespread across many areas of life, the overall role of debt in the economy begins to expand. Another factor that helped normalize debt was the expansion of consumer credit. During the second half of the 20th century, financial institutions developed new ways to provide credit to consumers. Credit cards became more widely available. Lending systems became more sophisticated. Financial products designed for everyday spending became easier to access. This increased access to credit made borrowing more convenient. Instead of saving for long periods before making large purchases, consumers could spread payments over time. Monthly installments replaced large upfront costs. This approach made many goods and services more accessible, but it also encouraged the habit of financing purchases through borrowing. Over time, installment payments became a normal part of household budgeting. A car payment each month, a student loan payment after graduation. Credit card balances carried from one billing cycle to the next. Individually, each loan might seem manageable. But when several forms of borrowing exist at the same time, debt becomes a regular part of financial life. Another reason debt has grown more common is the structure of modern education financing. For many students in the United States, attending college requires borrowing money through student loans. Higher education can improve long-term earning potential, but the upfront cost can be significant. Student loans allow millions of students to attend universities they might otherwise not be able to afford. At the same time, the growth of student debt has changed how young adults begin their financial lives. Many graduates enter the workforce already carrying loan obligations that will take years, sometimes decades, to repay. That changes the financial starting point for an entire generation. Housing also plays a major role in the normalization of debt. Mortgages are one of the most common and widely accepted forms of borrowing. Buying a home often requires a large loan that may take 20 or 30 years to repay. For many families, a mortgage represents an investment in long-term stability. But it also means a large portion of income may be committed to debt payments over many years. Auto loans are another example. In many parts of the United States, owning a car is not optional. It is necessary for commuting to work, accessing services, and maintaining daily routines. Because vehicles are expensive, most households finance them through loans. That means another monthly payment becomes part of the financial structure of everyday life. When mortgages, auto loans, student loans, and credit cards are combined, many households manage several forms of debt simultaneously. This doesn't necessarily mean people are acting irresponsibly. Often, these decisions are practical responses to the structure of the modern economy. When education is expensive, loans provide access. When housing costs are high, mortgages make ownership possible. When transportation is necessary, auto loans enable mobility. Debt, in these cases, functions as a financial bridge. However, debt also introduces new dynamics into household finances. Borrowed money must be repaid, often with interest. Interest represents the cost of borrowing, the price paid for accessing funds earlier rather than later. Over time, interest payments can become a significant portion of household expenses. This means that part of future income is already committed to repaying past borrowing. When multiple forms of debt exist simultaneously, these obligations can shape financial decisions for many years. Households may adjust spending, delay major purchases, or prioritize debt payments over other financial goals. Another important aspect of debt normalization involves changes in financial culture. Advertising, marketing, and financial products often emphasize convenience and accessibility. Credit cards offer rewards and flexibility. Online lending platforms simplify borrowing processes. Buy now, pay later services allow consumers to split payments into smaller installments. These systems make borrowing easier and more integrated into everyday purchasing decisions. Over time, the psychological perception of debt changes as well. Instead of being viewed primarily as a risk, borrowing may be seen as a routine financial tool. Monthly payments become part of the normal structure of household budgets. But it's important to understand that debt is not inherently negative. In many situations, borrowing can support economic growth and opportunity. Businesses rely on loans to expand operations. Homebuyers rely on mortgages to purchase property. Students rely on loans to access education. Debt can allow individuals and organizations to invest in the future. The challenge arises when debt grows faster than income. If wages grow slowly while borrowing becomes more common, the share of income dedicated to debt repayment can increase. This can make financial stability feel more fragile. Unexpected events, such as medical emergencies, job disruptions, or economic downturns, can become more difficult to manage when significant portions of income are already committed to loan payments. This dynamic illustrates how personal finances are connected to broader economic structures. Interest rates set by central banks influence the cost of borrowing. Housing markets influence mortgage sizes. Education systems influence student loan levels. Credit markets influence the availability of consumer loans. These system-level forces shape how debt functions in everyday life. Understanding this context helps explain why debt has become so widespread. It is not simply the result of individual decisions. It is also the outcome of economic structures that make borrowing a common pathway to accessing housing, education, transportation, and even daily expenses. This broader perspective helps explain why financial conversations increasingly include discussions about debt levels, interest rates, and household balance sheets. Debt has become woven into the fabric of the modern economy. That doesn't mean individuals are powerless within the system. Financial awareness, careful budgeting, and responsible borrowing can still play important roles in maintaining stability. But recognizing the structural role of debt helps clarify why so many households encounter it. The normalization of debt reflects deeper changes in how the economy operates. Costs have risen in key areas. Credit has become more accessible. Financial products have evolved. Economic expectations have shifted. All of these elements interact to shape the financial landscape that households navigate today. For many Americans, debt is no longer a temporary phase. It is a long-term financial component that must be managed alongside income, expenses, and savings. Understanding how this shift occurred helps bring clarity to an issue that affects millions of people. Because when people recognize that these patterns are part of larger economic trends, financial stress can be understood in a broader context. Debt is not simply a personal story. It is also a systemic one. And when we understand the system, we gain perspective. Perspective doesn't eliminate financial challenges, but it helps explain why certain pressures appear and why they affect so many households at the same time. Debt became normal not through a single decision, but through decades of economic evolution. Rising costs, expanding credit systems, and changing financial expectations gradually reshaped how borrowing fits into everyday life. Recognizing that history helps explain the present, and understanding the present helps people see their financial lives within the larger system that shapes them. For more calm, fact-based explanations about how economic systems shape everyday life in the United States, consider subscribing to The Money Context. Understanding the system changes how you see money.